The debt ceiling crisis continues. Catastrophe awaits. Hi, everyone, and welcome to another episode of Insights brought to you by Ainsley Bullion and the Gold and Silver Standard. Today, we welcome back Branko. It's Wednesday, and Branko loves to bring us all the doom and gloom news on Wednesday. No, not always doom and gloom, but probably he is again today, to be fair. So welcome back, Branko.
Thanks, Chris. Thanks for having me back. It's a little bit lighter news today, but still not ideal, I would say.
It's like, that's your catchphrase. It's, I'm trying to make it lighter, but yeah. So you're talking about today the debt ceiling, and that was it's something that I'm starting to pay a bit more attention to, because previously in discussions I've been having with people and just generally when we'll be talking about it as well, it's like they're going to sort it out. They're going to sort it out. But the more I'm sort of thinking about and hearing about it, the deadline's coming closer, because originally they're expecting they still had probably months to go, and now it sort of has to happen this month. And I'm also hearing that not that much progress has been made. So it's starting to come back on my radar a bit of, no, it'll be sorted, but maybe not quite as clear cut as we thought it would be. That, there's a lot going on there. So I think it'll be really good to dig into this today. And the first question I want to ask you about it is really that, big picture overview question. What is a debt ceiling? And specifically, we talk about the US debt ceiling here, and why does it matter? So if you can give us that big introduction to start with.
Yep. So just brief kind of big picture. The US debt ceiling, they just kind of keep wanting increasing it. And when they increase it, it allows them to borrow more money past a certain point. So they want to change it to 120% of annual GDP. Yep. And they're approaching kind of their previous limit, and they want to be able to raise it. Now, this is quite a common thing, right? You've probably had about, I think it was 78 since the 1960s debt ceiling raises, which is quite a lot.
So this isn't a new idea.
No, it's not a new idea. But why this one is kind of more significant is that we're at a deadlock, and effectively the Biden administration wants to be able to raise it with no strings attached, and the Republicans are only allowing them to raise it if they will cut government spending. And the importance kind of a deadlock is it can have significant economic effects, which I think we'll kind of get into. But the biggest one is in the event that it doesn't get raised, like we saw in 2011, which was the last significant deadlock. We saw the US credit rating get downgraded from AAA by Standard & Poor's. And then also we saw kind of sizable, economic decreases in GDP growth, things of that nature as well.
And I just sort of to elaborate on the point you're making about the Republicans being the difficult ones in this situation, it seems that it doesn't really matter which party's in. If you're the government of the day, the party that's in, you generally want it to just be no strings attached to passing the debt ceiling, because that allows you to continue governing and go about what you're doing. But if you're in opposition, it makes sense that you go, well, particularly in the US at the moment where everything is so fractured and so partisan, it makes sense that they want to go, well, this is something we can actually hold the government ransom on. So we want to throw other things into that discussion, and they've chosen more responsible spending, and no doubt there's some other objectives that they're trying to achieve in there. But it's a good one to hold the opposition hostage on, isn't it?
Yeah. On that quick point as well, so under the Trump administration, whenever they wanted to raise the debt ceiling, the Republicans obviously voted without strings attached and no conditions.
Yep.
Because that's their guy in power, right? And now they're trying to use it as a bargaining chip, and it's, doesn't matter whatever political side of the spectrum you're on, it's probably a good political strategy to, when your guy's in power, just let him do what he wants with the debt ceiling, and then when you're in the opposition, you want to get your own kind of incentives put through. So I think it makes sense from a political standpoint, but the significance is that there's the debt ceiling. So the Biden administration is looking for a way to potentially not go through the Congress and raise the debt ceiling, which there's really not been a precedent for. So that would be quite significant if that occurs as well.
Yeah, okay. So can you give us a little bit of background about some of those other deadlocks? Because you've mentioned we've been in this situation before, but not necessarily as bad as it could be this time around.
Yeah.
But
so
have you got some examples of others that were similar to where we are now?
The 2011 one was probably the main one with the Obama administration that we saw, where, like I said, the credit rating got downgraded. And then also I'd add to that is that the forecasts of this deadlock. So we have what's called brinksmanship, which refers to like this like a policy that comes in very late that causes some chaos.
Yep.
And so even in with this current level of brinksmanship, there's an expected economic consequence to that. And that is already as a result of consumer confidence being shaken, they're expected to see like 200,000 job losses and about a 0.3% decrease in real GDP, which is obviously a lot higher than nominal, which includes inflation. So already there's some consequence to that. And again, in 2011, we saw a similar outcome. And in the event that, in the highly unlikely event that they don't agree to a debt ceiling, then you could see like a pseudo Great Recession like event, because it would mean that the US credit rating would drop substantially and that'd just be absolute just chaos. And the forecasts are quite extraordinary, like a 5% increase in unemployment, 8 million job losses, and negative 6% real GDP.
And I saw that as so I've heard some of these numbers and I thought, oh, that seems like they're exaggerating. But then it was explained in something I was watching the other day about why those numbers are so extreme. And it kind of made sense to me, because if you start, for example, let's just say the government effectively does a shutdown that is broad based across the economy. Well, often people will still go to work, right? Because they go, well, or they'll still do their essential services because they go, well, we're going to get paid. We know this is not uncommon.
Government would never do a shutdown, Chris. What are you talking about?
Yeah.
That's never happened.
No, but people will still they know it's going to get resolved. They know they're going to get paid, so they'll still continue working. But when you're talking about these defaults potentially impacting actual savings, it has flow-on consequences very rapidly, because there are lots of institutions, lots of businesses that are relying on that money being there to pay their workers. So all of a sudden, it's not just government where people sort of are used to that. It's actually private sector as well that would be impacted. And the other point that they were making was that a lot of these funds that are holding government debt can only hold it if it's rated a certain way. And if you lose that rating because you've effectively, if you default, that means they have to dump that debt, which actually makes the problem worse, because then you've got, the fact they can't issue new debt, but also people dumping the old debt. It could spiral very quickly. Was the catastrophic sort of outcome in what I've seen. Is that along the lines of what you're sort of reading into that as well?
Yeah, absolutely. That's along the lines. And I think you mentioned the link to the consumer, but even like there are a lot of examples where this would just decrease the borrowing capacity of banks and therefore individuals as well, because if banks have a certain amount of capital, if banks have a certain amount of capital allocated towards bonds and the rating goes down, they have to like kind of, to support that increased risk, they often have to put more cash flow towards it. If that makes sense, like back it up. Yes. And that doesn't allow them to, lend with other people as much. So there's going to be a very large amount of like, onflows that would occur as a result of this in the event that,
like the unexpected, but still problematic. So I'd sort of like to we've got a couple more things we could talk about, but I'd like to wrap up that angle of it with this idea of the trends that we're starting to see, because the economic collapses, we've had, these impacts on the banks recently. We've talked about that extensively. The debt ceiling, it all seems to be tied together. So can you maybe give us your take on how all of this fits together, why we're experiencing these, the interest rates where they are, the inflation issue, the banks collapsing, all of that tying in together. What's your take on the big picture of how all that fits in together?
Yeah, a key takeaway for me to link this to like the bank collapses we're seeing is the importance of market confidence. And so talking about bank collapses, right, you have rumors come out of a bank collapsing, people panic, but they made the problem worse by withdrawing their money and the bank goes down.
Yep.
And I think we could see a similar thing with our economic system, where with this being in the news cycle, people begin to lose faith in the current economic system. And they see, wait a minute, like the government just, they don't have all this money, they just have all this debt and they can't pay for any of this stuff. What's going on? And then when they lose faith in the economic system itself continues to diminish and we see further problems. So I think that this has kind of highlighted the importance of market confidence and the decrease that we're seeing. And to back up this decrease, we've seen an increase in the spread on credit default swaps, which are used to insure US government bonds. So that confidence is already decreasing. And similar to like banking contagion, that confidence can sort of cause the problem itself when that confidence goes down. So I think that's going to be a very important indicator. And I think, obviously, working in the bullion space, we see a lot of people who have lost a lot of faith in the economic system, and then that space itself is kind of continuing to grow as well. So I think this will be a broader trend of people, if this continues to be in the news cycle, people seeing the issues in the economic system, and then that could cause further issues.
And I find that point fascinating because highlighting, I think often this confidence game only works because people don't really understand it. And I think you just hit the nail on the head. When you make a big show about it all, the unintended consequence is people actually go, hang on, what is this actually about? Take the time to go and do their own bit of research and get a little bit angry. And when they come to that realization, hang on, this is all just nonsense. It's like, it's all just a bit of a pyramid scheme. And that's probably the last thing they want. So if they were actually smart about it, they'd probably be keeping their mouths shut and going, oh, well, we'll just make this happen. So the noise and the chaos that the politicians are kicking up about it could ultimately be their downfall here.
Yeah, absolutely. I think they always probably want to just put this stuff under the radar, and they have done a pretty good job considering they've raised it 78 times before. But when they bring attention to it like now and it doesn't get solved, then people start probably waking up a little bit.
Yes, and we're in that social media age now that's different to possibly 78 times before, where once people start to realize things, they can share that knowledge in much better ways than would have existed in the past, where it was all sort of controlled. So it's certainly interesting times to be in that space as a politician or working in government. Finally, we did have a question I just wanted your opinion on. This was from Addicted to Macro on YouTube, who was asking about the thing we were talking about on Monday with Alex, which was shorting. And his question was, or his or her question, whoever it was there, was if an entity always takes the other side in a short, who has the other side on the massive shorts rumored to have been taken out by JP Morgan? I know JP Morgan are the winners if the price of gold drops, but who are the losers? And I know you've talked about this before because it was actually not even a conspiracy, was it? They were actually convicted or found guilty of manipulating the silver market.
Correct. And I think in this situation, I think retail will be the most likely loser.
Yep.
Just generally, I think retail's on the other end of these shorts. So I think that was absolutely confirmed. JP Morgan were manipulating the precious metals price. And I think, usually like whether it be traders or long-term holders, obviously they would be negatively impacted by the short selling. And
my understanding of it is that if you're JP Morgan, for example, the reason they were shorting was so that they could keep the price nice and low, even though the price was trying to move up. So they're keeping the price low. And I think they were, the argument was at least that they were buying a lot of the actual physical underlying metal. And then eventually the idea is then you take the short off, like you close your shorts where you've profited that way and let the price rocket up, and they own so much of it because they manipulated the market. And of course that is illegal. You're not allowed to when you're at that scale. And it becomes even more problematic when you think about the sweetheart deals that JP Morgan's been getting with the banking collapses. Like it's really outrageous when you think of it in those terms.
I agree with that. And I think that I think you explained that very well, how they work. So they have profited on both ways. It's kind of like with Goldman Sachs during 2008, they would sell like their CDOs that they knew were very bad. So they'd make money selling the product, and they'd also make money buying insurance on them to fail. So similarly, JP Morgan are making money on both ways as well, shorting the gold. And then when everyone kind of stops out and they've hit the bottom, they then hold it and wait for it to go back to its natural price.
It can send you down a rabbit hole and make you very jaded, spending too much time reading into those. But yeah, it's certainly an interesting conversation, isn't it?
Mm-hmm. Yep, 100%.
Well, Branko, thanks as always. There's lots in there today, as there always is. A little bit of positive news, but still kept your Doom hat on, so that was good. We love that.
Hopefully, we take it off soon, but.
Yeah, another week. We'll see how we go on that debt ceiling over the next few weeks.
Yep.
Thanks everyone else for watching. Remember, reach out with those questions, comments, social platforms. We read those. We'll get back to you on those when we can. That's us for this week. So we've got lots of data still coming out of the US, and we'll be watching that debt ceiling debate. Lots to watch, lots to pay attention to. We'll be back to discuss those next week. So until then, stay safe in the markets, everyone, and we'll talk to you later. Bye.